Chuck Carnival, and I'm the Chuck in the Markets Up Chuck. And today's, discussion was the fact that, I really designed this blog to be a video blog. It's not what I write, but what I want to show you with what I consider to be a picture worth 1,000 words perspectives of, individual stocks versus general markets and what the general market's doing, because everybody seems obsessed with that. So let's start by looking at the S&P 500. Here's a 20-year chart of the S&P 500. I've shown this chart before. There was a period which caused the great bear market from 2000 to 03 where it was dramatically overpriced. It's currently trading at on the high side of a normal price-earnings ratio of between 15 and 17. But the point I want to make is the average earnings growth of the S&P 500 has been about 5.5%. So like Warren Buffett said, there are good companies that are really terrific businesses, and there are average companies. We're going to look at two companies today in the shoe business just to kind of make that point and clarify it. My first example will be Nike. It's obviously the dominant shoe manufacturer in the world. I want you to notice that Nike has had a very consistent, record of earnings growth. It has a little lumpiness here and there, but it's averaged about 11.2%. You can kind of count on Nike to throw off good numbers. It averages 1.8% dividend yield. Over this 20-year period, a $100,000 investment in Nike would have grown to over $1 million. That's a 13.7% rate of return, and that's compared to a 6.2% rate of return that the S&P would have generated since 12/30/1990, or almost double what the market has. So, really Nike has been a really terrific company over this 20-year period. Now, if you compare that to another company that's kind of technically in the shoe business that actually sells some of Nike's brands, you get a different perspective and a different picture altogether. This is Foot Locker, and what I want you to notice here is Foot Locker's earnings have been all over the place. They've been pretty strong here in the first period, then they dropped, and they rose again and dropped, and then they rose for a period of years here, and then they've collapsed again. And as you can see, the stock price has correlated to those earnings and followed that. But this is not one of those terrific buy and hold investment, businesses that Warren Buffett talks about. A $100,000 investment in Nike, since 1990 would have actually shrunk to $35,000. That's a negative 5.4% compounded rate of return versus that 6.2% in the market. So there's a lot of talk whether the market's going to go up or down. Now people say the market's overvalued. We looked at that a moment ago. The bottom line is there are individual companies out there that you should be looking at and be owning. You shouldn't own all the average companies, in our opinion, or my opinion. You should only own those really terrific companies. If you look at Nike today, I believe Nike's trading at a significant discount to its normal valuation, pays a nice dividend, and is going to be a terrific business for a long time to come. This is Chuck Carnival. I want to thank you for listening, and as I always say, do your own homework. But the point is, there are good businesses out there. Separate the wheat from the chaff and look for those things that make sense, and ignore all the generalities and all the hype and hysteria that the media likes to throw out. It's Chuck Carnival saying thanks for listening.